Hi guys. So in today's session, it's going to be a very short one. I'm just going to explain to you what are the market timeframes. So if you go on the left side of the chart or if you're on a computer on the top left side, you will find some time zones that you can use, uh, which we call in the trading world we call it timeframes. So if you click on this, you see date ranges. So you can select each one of them, and the ones that are common are the 1 month, the 1 week, 1 day, 4 hours, 1 hour, 30 minutes, 15. Basically, everything that I have favorited. And we're gonna mainly focus on the 1 minute chart, on the 5 minutes, the 15 minutes, 1 hour, 4 hours, 1 day, and 1 week. Okay? So whenever we want to start trading, we will go to the 1 week, okay? 1 week charts. So in the 1 week charts, I like to go from, let's say, 25 of April, and I like to go all the way back, okay? I don't want to study it. So I don't care what happens previously, okay? But it's just a reference of what will help us in the weekly to take our bias. So in the weekly, what I want to teach you here in all the time frames is that whenever you see a higher high and a higher low, so for example, if I see a higher high and a higher low, I'll take the Fibonacci, okay? I'll take the Fibonacci and draw it from this bottom here on the weekly chart to the top. And I see that the price has went below the 50%. It rejected here at a discount. So when it wants to be bought, you're gonna buy it within the discount range, okay? You don't want to buy it at a premium range, okay? You would rather prefer to buy it in a discount range, because that's where the highest profits are, and that's how you're gonna get the best of the best trades that you want to enter. So in the weekly time frame, we can understand that the prices are going higher and higher and higher. So they're not rejecting towards the downside. So we can understand that after this rejection, price got sent and shot higher. So now what happens in the weekly is that there's a market structure break. So a market structure break happens when a higher high, higher low, higher high, and higher low, higher high. Okay, now this structure is broken. All right, so the price of the market already pierced through it. However, we cannot confirm this until the price, after it goes up, which is what it currently is doing. If it tries to go back downwards, then the market is in a bearish trend and we could see lower prices in NQ. So prices could go even lower to target this higher low that was previously done, and we will see a very strong momentum towards this price. Okay, we will see very strong momentum, but we are not confirming anything. We're just looking at the price, we're checking it, and is it actually happening or not. Okay, so I will delete this. You may use it as a reference in the future. Okay, but I want to see the most recent higher high and higher low. So this higher low to the higher high, okay, we take it and we study the charts. I think I took the wrong side, so it should always be the 0 at the bottom. I think the one at the bottom, sorry, because we want to go up higher. All right, so we want the price to go higher, so we wanted to do similar things here. A fake breakout takes the 50%, rejects through it, and sends the price even higher. So if we go to the daily, zoom into it in the daily, we can see how the price is rejecting very nicely through this. It went up the 50%, went above it, and now it went down. It went to the discounted price below the 50%, and then it went higher. Okay, the price got shot higher. Okay, so what we will do is that since this move is the highest move, okay, we'll draw another Fibonacci. Since this move is higher and it broke the market structure, so I can see that at this point I would rather be a seller of NQ. Why? Because there's a market structure break. So the market structure break at this line, I would rather sell at the premium range here, above the 50%. You can see the 50% is here. I want to sell in this premium, okay? When the price is very high, that's when I want to sell, because that's what you do, right? When you have a property and it's having a very huge amount of money, you want to sell it, right? When it's appreciating in price, you want to sell it. So the same thing here in the charts and in trading. So when the price reaches a very, very, very high pricing, you would rather be a seller than a buyer because the market tends to sell. However, in this manipulative markets, we don't know whether it's selling or buying until we get a certain market confirmations. Okay, we don't assume that at this point 62% here we're gonna sell. All right, we don't assume as soon as it goes at 50% and above we're gonna keep selling, no, the market has some data that will tell you when to sell and when not to sell. Okay, now we go and zoom in. We're just at the daily. All right, we're just at the daily. Okay, when we are at the daily, we might as well mark the equal highs. Okay, we might as well mark the equal highs in the daily. Okay, mark the equal highs. All right, is there an equal high here? We mark it here. Almost equal highs there. Okay, and there you get another one here. Let me just delete the Fibonacci's that I drew. I delete them. Okay, now let's keep only those and let's go zoom in. 4 hours. Let's go see the 4 hours. So in the 4 hours, we're gonna do the same thing. What did the market do? The market went up, higher high, higher low. So I'll show you what it did. The market went all the way down in a movement of lower lows, lower highs, lower lows, lower highs, lower lows, lower highs, and suddenly market breaks structure. It goes higher high, higher low, and then boom, another break of structure. So structure is broken. All right, it trades back up. All right, that's what we want to see on the daily. It trades back up, and then it fails. It gives up. It keeps selling. It keeps selling. It keeps selling, and then it breaks. It wants to break another market structure. So it goes higher high, higher low, higher high, higher low, and then another market break structure, and then higher, lower high, lower low, and then here it flips. It wants to break structure again. So that's how the market is. And the strongest trades we want to find is whenever the market is breaking structure. So from the beginning, before it breaks the structure here, we want to understand that the market wants to send the price higher or wants to send the price lower at this point. Okay, so if we're taking those trades, we're gonna have the bulk of the trade and we're gonna get out with loads of money. So that's where we want to identify most of the trades. Before reaching to the break of structure, we want to already have a decision that the price is already sending prices higher. Okay, how can you do that? Well, you're gonna do the same thing. Whenever a higher high and a higher low is created, okay, or lower low and lower high is created, take it from the beginning of the move. Since this is a higher high, a higher low beginning to a higher high, okay, the beginning of the move. So wait, like I said, when we wanted to price, when we're assuming the price is going higher, it should be sending price from the bottom to the top. Yeah, so make sure that the red lines here, 62%, is at the bottom. But if price is going higher, we're expecting price to go lower, we do the opposite. All right, so for example, in this trade here, from this top to this bottom, okay, this one to this one. So when we're expecting price to sell, the 62% and 79% should be at the top. Okay, so every time the price reaches to these values above the 50%, there's always some structure that is made in the market. So always go to the higher time frame, to the lower time frame, to understand why the market does this variation and gyrations, and why does it go up and down, up and down. So every time the market does a higher high, to a higher low, take the measure the move with a Fibonacci, and just wait and watch. You want to preferring to go on a sell side, or you want to see on a buy side. It all depends on what the market is previewing for you. If it does a lower high to a lower low, you take the Fibonacci from the top here to the bottom, and you expect the market to sell. All right, you expect the market to sell. But if there is an in-between movement of a higher high and higher low, you take that low to the higher high, and then count, just check whether it provides you a good opportunity to trade, and so on. So you always keep zooming in into the time frame. You do the same thing, and the more you zoom in, the higher time frame Fibonacci will show you more dominance in the 1 hour. So it will draw for you an exact amount, and you'll see that the trade is respecting the higher time frame. And when you zoom in and you zoom in, it's just gonna draw for you the minimal trades. Okay, it's gonna zoom into the spec of the trade. Okay, so that's how you do it. You're gonna zoom into the piece of rice, one piece of rice of the trade, so of the bigger trade. Okay, so that's how the time frames are very important. You keep doing the same thing in the lower time frames, draw Fibonacci from a higher high to higher low, and then check how the price reacts. If it's giving you a bearish sign, you want to enter from the premium. If it's giving you a bullish side to go higher pricing, you want to buy it at a discounted price, which is below the 50%. All right, guys, thank you very much, and make sure to like the video, and I'll continue more on this on the futures. All right, on the future videos. Thank you.